our topic today is funding. And over the course of this previous year's seminar series, we've had a number of topics that we've addressed, and many of them have lightly touched on this idea about funding, what people did do or didn't do. And we thought it was time to dive in. We needed some more information, some more details. So we have two great speakers who are joining us today. And if I can introduce first, we have TK. I should have made sure I know how to say last name.
Kuegler.
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 Thank you. Co-founder and general partner of Wasabi Ventures. And interestingly, TK started his first company at 15 and sold it 3 years
Yep,
later.
I was 18 when I sold it.
Yeah. So he maybe has been in this business a few times.
A couple times.
He's had a few startups, and eventually he made his way into venture funding. So we're going to do two parts to our discussion today. The first is TK is just going to talk to us about types of funding, to get us all oriented on the same page. And then we'll talk about the experiences that he has as an investment funder. And then we're very fortunate also to have Cory von Wallenstein join us.
How come you can say his name and you stumbled on mine? You paid her. That's what it was. So.
Nice to know there's a price for everything.
Yeah.
You introduced yourself as TK. I
Yeah,
introduced myself as Cory von Wallenstein.
Yeah,
I
fair
ceded.
enough. Yeah. Fair enough.
All right, so Cory is the CEO of Adored, which is a customer-centric mobile app startup. And prior to founding Adored, he was a chief technologist and CTO at Dime. And Cory was the founding investor of TrendSly, which is a SaaS business intelligence company, as well as in the New Hampshire Tech Out startup competition. So you've sat on various sides of the funding table, and so we're glad that you can join us today to talk about the experiences you've had, maybe some of the pros, the cons, the goods, the bads, the uglies.
Lots of uglies.
And so with that, we're going to start off with you.
Okay.
And if you can just get us oriented, talk to us about how you think about funding, the categorizations you have, what it means to you.
Yeah, I think the best thing to look at about funding is that you have to ignore all definitions that you could possibly read, because most of the definitions are pretty muddled in the marketplace. So you'll hear things like friends and family rounds and seed and late seed and early seed, post-seed rounds, bridge rounds, early price rounds, a Series A round. Those are all things, and they could all mean exactly the same thing, just so you understand. They're all very situational in the current marketplace. But what I want you to do is just think of they're really all the same. No matter what definitions you hear or where you are, every time you get to an instance where you're going to raise money, the approach, the process, and the actual getting of that cash is exactly the same. It may have a little nuance here or there depending on who you're dealing with, but it's going to end up and be the same. So that's just so we're all on the same page. Cory will probably tell you the same thing. I've seen companies that raise $3 million and the process happens in matters of days, and I've seen people raise $500,000 and it takes a matter of years. So there's no sense of timing. It doesn't really matter who you're approaching. The variables are kind of all over the place.
So when somebody comes to you and says, I want to talk about funding, do you need to kind of take a step back and say, so what do you really need? Or is there a general conversation that you just say, okay, this is what we can talk about when you say funding?
Yeah, the interesting thing is that if they come to us and talk about, and they start off that they want to talk about funding, I already probably know I'm not interested.
Why?
Because if somebody is seeking funding, then they're probably not that interesting to me, if that's their first thing that they lead with. I know that seems counterintuitive, but it is. So just to give you some ideas on our firm, an average week for us is 126 pitches. Just let that sink in for a while. 52 weeks a year, 126 pitches, and that's for the last 5 years. So 30,000 plus pitches we've heard in the last 5 years. So there really isn't much early stage that we haven't seen or heard. So you kind of get a sense pretty quickly what you're looking for. The best conversations actually start where the money comes at the end, not at the beginning. I usually break down and try to understand the people first and foremost. Now, you also have to remember there's a spectrum of investing. So that's the one thing that is real. You've got to match the people with where you are and what kind of money you're looking for. So we're at the very earliest part of the spectrum. So that's where we like to play. Everybody has, every horse has its own course, and that's where we play. There are plenty of firms that play later stage. We tend to play down where nobody likes to play. So our world is all about the people. I actually tell my staff, if I see a spreadsheet during the pitch, I know I'm already going to say no, because I know that the focus is in the wrong place. So it's a lot of counter things in our world compared to later stage. Later stage is all about numbers, because there are even firms, I won't name them, Sequoia, that their entire model is that they're going to fire the staff sooner, or the management team anyway. They already know that going in. The management team should know that, because they do it every time. They're going to fire you because you're going to do something that they didn't like, and they're going to bring in their own people. That's their model. It's what they do. So they didn't care if you lived or died. They already knew what they were going to do with it. So that's not good or bad. They're very successful, and it seems to work out. So, but everybody has their own approach and what they like to do.
Can you tell us a little bit about Wasabi Ventures and how it's structured and what your goal is for that company?
Yeah, that company meaning us?
Yeah.
Okay, so.
Right.
Yeah.
Yes, you.
So, I'll just give you a quick background. We've been around since 2003. Two founders, myself and a gentleman named Chris Ye. Chris is a West Coast guy. I'm an East Coast guy. Chris went to good schools. I went to shitty schools. So we're a yin and yang in almost everything. So if you ever meet Chris, he's very even keel. Everybody likes Chris. I can't say that about me in any way. So,
Everybody says his last name.
Yeah. Everybody says his last name well too. So, but anyway, it's been around 2003. 4 key things that are unique about us. We play at that early stage that I already mentioned. 40% of our investments are pre-product, pre-revenue. So real early. Second thing that makes us unique, for most of our existence, we worked out of one general fund, an evergreen fund, where Chris and I were the only LPs as well as being the GPs. So we made 200 plus investments with our own money is really what that means. Gave us a lot of flexibility and a lot of creativity.
LP and GP?
Oh, sorry. Yeah. LP, limited partner. Those are the people that give
his boss.
Yeah, my boss. In this case, my boss would be myself. So it's a little creative. But LPs are the people. Think of it as a mutual fund, which people are probably familiar with. A mutual fund has people that put money in, and then managers invest that money. The LPs in that model are the people that put the money in the mutual fund. The GPs are the mutual fund managers who actually make the investments. So Chris and I basically were betting our own money for, most of that time. Switched up a couple years ago. We added another fund, but generally speaking, it's been us the whole time. If those two aren't unique enough, and if you don't know the VC space, those are both really unique. But it gets crazier. In about a third of our deals, we're actually co-founders, meaning we find people we like and we build a company from scratch. They don't even have an idea half the time. We just find them, like them, and then build a company from scratch with them, providing all of the resources all the way up to a price day round. So that's the commitment we make to them. It's a very unique model. I don't know anybody else in the whole world that does it the way we do. And then lastly, we run the Wasabi Ventures Academy. It's a free educational institution teaching people how to be founders. I have a student in the back row right now. So, but yeah, that makes, we've had about 1,000 students go through it in the last 5 years. So anyway, that's kind of who we are. We cover the whole gambit of investment as far as verticals. The only thing we don't touch is biomed. So if the FDA even has to look at it, we don't care, is generally a rule.
So what are your processes? How does somebody darken your doors, and how do you find them? How do they find you?
I would say 80% of what gets to a pitch is referred in. Somebody says you should talk to these people. And then it goes through a sort of matriculation process to end up at a pitch. But we're fairly approachable. So as long as you can fog a mirror, you're going to probably get a chance to pitch to us. The bar's pretty low. And then a pitch is usually a phone call. usually lasts about a half hour. Either myself or Chris or a couple other people will take turns sitting in on them, depending on who the person is and maybe what the specific vertical or specialization is. And, it just goes a simple question and answer thing. I'm usually done deciding if I like them or not in about 4 or 5 minutes, though, on a phone call. In about 4 or 5 minutes, I know if I know all the easy no's, so I already know what they're going to be. So as soon as I hear them, then I can mentally tune out and rip them a couple times. I'm notorious. My staff calls me TK, the crusher of dreams. But I don't really look at it that way. I call it an enlightenment for them. But I try to leave it on a good spot at the end. Yeah. I will say, and this is a good segue back to the topic here. I promise you we get back there. But I would say 95% of the pitches that I listen to, I tell the person on the phone to stop raising money. Just stop, for a variety of reasons. The biggest reason usually is that their dreams are messed up. I'm actually working on this book, and my concept is that startups are really dreams, and they're the dreams of the founder. And the minute you take any money from anyone, including Aunt Gertrude, your dreams are no longer your dreams. They're now our dreams. And if our dreams don't match, it's not going to end well. And it's not going to end well for you. It's going to end just fine for me. But it will not end well for you if our dreams don't match. So the message I want you to take home from anything that you do tonight is that if you think you're raising money, make sure that your dreams completely align with whoever you're taking money from. That's the key. And don't take money until they do. You can't raise money. Remember I started with seed money and angel money and institutional money. You can't take money from anyone if you don't think you're going to build a $100 million company. You can't do it. It's not going to end well. Doesn't mean you have to get to a $100 million company, but if that's not the dream, don't raise money. And we can talk a lot about why it'll end badly, and might be off topic actually, but it's your dreams have to completely align with mine, or you can't take my money, or anybody else's. I mean, we'll bring Cory into the talk. I mean, Cory will talk about this too. I mean, he's doing Adored right now, and Cory and I had this discussion, and Cory's done a fantastic job. And he's getting ready to get a nice round done. And that round matches with his dreams. But maybe 3 months ago, the dreams were different. And so a slight adjustment to the dreams, in a good way, allows you to get to a place where you can raise that money.
Well, the investors have their expectations, and they have their own bosses that they're beholden to, which are their limited partners. And those folks expect return on capital. And if you're someone who has been successful and you're investing in a venture fund, and you're going to ask that venture fund, I want 5, 10, 15% annual return on my money, 5-year fund, they have to hit really big wins in the companies that they invest in order to match those expectations of their bosses. And who are they putting those expectations on? They're putting it on you. And so if you can't meet that threshold of this is at least going to be a $100 million exit opportunity, it doesn't make sense to raise any capital because the interests are just not aligned.
That's right. Yeah, I mean, and even if you take it back, because this is the classic how this conversation goes when I have an early stage founder and you have this discussion with them. Yeah, but I'm only raising $500,000 and I'm getting a great deal on it. I'm getting it at a 5.5 pre. And I'm only giving up, 1/6 of my company or whatever the math ends up being. Okay, what are you going to do with that $500,000? That's the next thing I usually ask. We're going to hire this person, this person, this person. We're going to do a bunch of spending on marketing, and we're going to do this. Okay, 3/4 of that isn't going to work because it never does, and you're going to be broke again, and you're going to need more money. How expensive do you think that money is going to be? And by the way, you're really lean right now and you're only burning $25,000, $30,000 a month. Fantastic, that's great, love to hear that. When you hire all those people, how much are you burning? $65,000, $75,000, $85,000 a month? What are you going to do, let them all go? Probably not. So you got to raise a whole bunch more money. You don't think the investors understand already how this model works? You don't think they understand that they're going to get you on round two? And not in a negative way. It's not vulture capitalism. It's just how the game gets played. It's exactly how the game gets played. It's why follow-on pro ratas are mandated in most term sheets. And what that means, for those who don't understand, that means when I put my money in, the next time I get the right to invest at that round as well. You can't leave me out. So that way I can keep myself whole all the way if I still believe in you. You as a founder, you don't have any money. You can't invest again. So your 45% goes to 25%, goes to 16%, goes to 8%. Now, what you'll read is, but look, you're getting 8% of a massive pie. Maybe. Maybe you are. But talk to most early stage founders who are successful. The vast, vast majority of them will tell you that they don't like being that late stage player. The man sitting right next to me left Dine. He was the CTO at Dine. And why did he leave? Because he wanted to get back to actually building a company from scratch. It's where he likes it. It's about dreams. His dreams match there. And I promise you, if Adored's highly successful, he'll get to a point where he's not going to like Adored and it's his own
It'll
thing.
be 255 people or so, just like Dine was.
But he won't like it because his dreams don't match there. But he's already reconciled that in his brain. See, it's about your dreams. I have a portfolio company who has 35 employees, makes about $5.5 million a year in revenue with nice organic growth and about $1.5 million a year in profit. Sounds like a great business. Completely not fundable. Not fundable. And the founder figured that out a few years ago. But she loves running the business. And as long as I'm the only money in and it works for me and she's going to kick off $750,000 in cash to me a year, I can live with that. And she can too. But it's about my dreams matching her dreams. If I was a different investor, that doesn't work at all. I would have already told her, we got to sell this thing. And now all of a sudden the dreams don't match. You see how the dreams are important? It's not necessarily about just chasing unicorns.
So let's use that unicorns. It's a perfect segue. Cory, can you tell us a little bit about Adored and what your idea was behind it, and then how you got to where you are today in terms of interested in funding, what you want to try to do with it, why?
All right, to understand my story, I do have to do that in reverse. I have to tell my Dine story first. So I joined Dine back in 2008, back when we were a very slow growth lifestyle company trying to figure out how we could do interesting tech things in Manchester. We figured out how we could help some of the largest and fastest growing websites on the planet grow faster and be more reliable and be more scalable. These are great folks like Twitter and Netflix and CNBC, and the list goes on. But when that and through that journey, we bootstrapped that company for most of its life. It's actually a 17-year overnight success story. Mm-hmm. And I think that's the piece that most people don't realize when they look at companies that are successful, is just how much time goes into that venture. So that was 17 years to get it to where it was. And if we had raised capital early on, we might have been able to accelerate that time, but we would have essentially lost portions of control of the company to investors and would not have been in control of our own destiny. And so we were constantly making the choice as an executive team, do we want to raise capital? Or do we want to continue to grow with our own revenue and the risks and rewards therein? It was in 2012 that we decided, okay, now is the time that we want to raise growth equity. We raised a $38 million Series A from Northbridge Ventures. And the key thing to recognize about that type of deal, that was all numbers. Like, how fast is the company growing? Are you exceeding a 40% year-over-year revenue growth? How are you going to apply that capital to grow that business even faster? And there were things that we needed to do as a company that capital made possible, and it was a wise decision for the company to do it then. I can't say it would have been a wise decision to do it before then, because there were many people that raised venture capital to build a business like Dine that were not successful, because they tried to grow too fast to meet those investor expectations. They had to hit certain burn rates in order to show how they were moving the needle. But what enabled us to succeed was growing slowly and steadily and constantly improving our reputation and reliability. And it was actually because we chose to grow slowly that we were more successful than others. But that was very, very nuanced in particular to that business and that industry, internet performance. And it's a complete 100%, 180-degree about face to what I'm building now, which is Adored. In my journey at Dime, I was CTO up until about 250 people, and I decided it was a question of when, not if. I just was not thrilled getting out of bed in the morning, operating a large company. I longed for the early stage again. And so I worked with my executive team and put together a year-long transition plan. Basically spent the first 6 months rebuilding the technical leadership team. The next 3 months after that, traveling with customers, helping them understand what was going on. And 3 months after that, basically making sure nothing caught on fire before I even started thinking about the next venture. But the thing about the next venture for me was always, all right, if this is what we've accomplished with Dine in terms of industry impact, community impact, employee impact, because when I left, we were 450 people. And that's just the phenomenal impact that you can have on people's lives to be able to have that large of an entity. And so I wanted to do something that would, be even larger. It's something that I believe in order to drive improvement in our communities and to attract talent around here. We have to have big victories. We have to have big wins. We have to be able to say that we can build fast growth companies here in New Hampshire, the Metro Boston ecosystem, and they can touch a lot of people in really impactful ways. So that became a guiding light for me in what I wanted to do, and basically went out and talked with a lot of friends to understand what kind of trends were moving in different parts of the markets, talked with a lot of business owners to understand what pains they were facing. I'm adamant that anything you build as a company, you have to be solving someone's top 3 pain points of what's keeping them up at night, because the difference of solving someone's number 1 pain point versus pain point number 12, pain point number 1, they're going to write a check to an untrusted startup and an untrusted team because that pain is so painful, they just need it to go away. But pain point 12, they have 11 other things they have to get through before they're even going to give whatever the hell you're trying to pitch to them a try, right? And so we made sure that we were picking pain point 1, pain point 2, or pain point 3. And for us, that was helping business owners establish more meaningful relationships with the customers they already had and trying to find new customers that looked just like the existing customers they already had. And so for that became the venture Adored, that is using a technology that Apple created called iBeacon. It basically lets us engage a smartphone as it walks on property within 200 feet, and we can give that consumer automatic loyalty rewards. That's the reason the consumer puts the Adored app on their phone. But in return to that business owner, we can now automatically segment the different types of users that are coming onto their property. And people that were coming at the pace of once every 2 months, we can get them to come once a month. People that were coming once a month, we can get them to come twice a month. And we've proven that we can move the needle on consumer behavior by putting the right message in front of the right person at the right time. And it's caught on fire. We went from 15 locations in a pilot to now 30. We have 60 coming online by mid-May. Launching in Portsmouth mid-May. We just brought on Mount Washington Valley. We have 6,200 consumers. And along the way, we've basically been honing our story and honing our pitch, trying to understand the right combination of value to consumers, value to locations, and then value to investors that are going to buy into this journey with us, and selling that journey every step of the way. So that's brought us to where we are today.
I'm sorry, when did you start the company?
We founded it August 29th. We did a very crude pilot in 2014. Yeah, very crude pilot in October and November to understand what the experience looks like. I don't think we actually understood what the business was going to be until about February or March. We've only just started to figure out, okay, this is how we can apply this technology. This is how we can deliver experience. This is how we can deliver value. This is how we can sell it. This is how we can go to market with it. This is how quickly we can grow it. And these are the risks that we don't yet understand that we have to then mitigate.
Yeah. And so you were looking at funding.
So you have to understand the type of venture that you're building dictates, and who you are dictates whether or not you should get funding. Like, that is just the harsh reality of it. Unless you are committing yourself and everyone who's working around you to 7 to 10 years of hard work, of not being paid, of putting everyone else's needs in front of your own, and just scraping by every hour of every day. If that does not sound exciting to you, to build a company that's worth $100 million or more, don't raise funding. It's just a complete mismatch of expectations. But the level of impact that we wanted to have and the opportunity that we saw in this business dictated that we needed to move fast. And in order to move fast, we did need to raise capital. And so we started just with people that we knew in our network. Folks like Paul English, who founded Kayak and now runs an incubator in Boston with Bill O'Donnell called Blade. Wayne Chang, who runs product marketing at Twitter. We had Laura Fitton from HubSpot. We had the entire Dine executive team invest in the company. And it's the thing to understand about that stage, the investors are not investing in your idea. They're not even investing in your company. They're investing in you. They're literally thinking to themselves as you're sitting in front of them, talking about whatever the hell you're talking about, am I going to hire that person to make money for me? Period. Because that's all there is to invest in at the early stage. It's just people. And then it switches 180 degrees when you get into the growth stage of funding, when you're already operating a large company, you're trying to take it to the next level, and now it's all about the spreadsheets. It's all about how are you going to apply that capital? What are you going to do with it? What new milestones can you get to? And it's one of the reasons why we've raised this funding that we've gotten to date. We've raised $440,000 as convertible notes, and we're pulling together $1.5 million preferred round now, and we have 1.15 million of that confirmed and committed. So we still have a little bit to go to get the round closed. But the key to raising that for us was not showing slides, not showing models. Just like TK said, if I had walked into any of these places and brought in spreadsheets or models or even a pitch deck, I would have been thrown out. I sat with them and I talked about what we envisioned the world to be like, how we're the right people to bring that vision to reality, and what we need to make it possible, and talked about how they would play a critical role in getting us to different milestones along the way there. And there were some people that were natural fits for investing in that, and some people were like, nope, not touching it. And that was okay. Like you need to be polarizing in your ideas and who you're talking to, because when it aligns very well, and if it doesn't, just move on, and that is perfectly okay.
So does anyone ever invest in an innovation idea, or is it always the people or the company and its potential?
Stage dictates all of that. You know, I teach this class, and the first slide is all ideas suck, and it's true. All ideas are bad. Think of every startup that you can name that's really successful, and their model is not the model they pitched originally. I promise you, it's not. And why? Because
first changes monthly.
Right, because the model isn't any good. The idea is terrible. It's supposed to be. It's can those people actually do something to adapt and adopt to whatever the market's telling them? So places where IP gets bet on are specific verticals. Embedded systems tends to have a lot of IP bets played. Biomed has a lot of IP bets made because those pieces matter. But in almost everything that you want to classify as software, and probably 80% of what you want to classify as hardware, it doesn't matter at the early stage. The idea literally doesn't matter. I know there are patent lawyers in the room. Patents don't matter. They just don't. So
the only thing that matters is execution.
Right.
Your ability to demonstrate value to customers who are going to open up their wallets, take money out, and put the money in yours in exchange for their pain going away or solving some opportunity that was previously unmet. That's it. That's everything.
Yeah. So I have this thing, and while I'm doing one of those pitches that I told you, I instantly know if I'm going to like it. The biggest thing I'm thinking is, do I want to have a drink with this person or not? I'm literally thinking that in my head. If their voice is annoying, it's probably a big strike. I'm going to have to spend a lot of time. In my world, I have to spend a lot of time with this person. If I find them completely annoying, I don't really care that they have a good idea or they're brilliant or they went to MIT and Harvard and Stanford all at the same time. I really don't care if I find them annoying. True story. We have a portfolio company in New York. This is one of the few times where Chris and I completely disagreed. I absolutely didn't want to invest in this guy, mostly because I find him the most damn annoying person on the planet. And I told Chris, I said, if we bet on this, it's all on you. I don't ever want to speak to him. I literally can't stand him. So we made the bet. I caved. And anytime he pages me, texts me, if anybody who knows me, I am the most approachable guy in the world. I take calls all day, 24 hours a day. I'll talk to a founder. I won't talk to this guy. That's how annoying I find him. So I don't care. I'd rather lose my money at this point than have him win. That's how bad I find him annoying. So anyway, so I digress. But the point is, it's about the people. It's really about the people. I'm really trying to just drive home the fact.
No, it's not
Cory.
No.
I don't think so. I only hate him most of the time. That's right. Occasionally I like
it's a very healthy tension.
Yes. So, but yeah, I mean, it's all humans at that point. Yeah. So to your question, IP matters. What matters is when they come in and they talk about their idea, can they articulate? Are they articulate about it? Can they defend it? We invested in WanderU. Anybody know WanderU or not? It's a Boston-based startup. It's gotten a lot of attention. Think of kayak for everything that's not an airplane. Buses, trains, boats, you name it. They provide kayak for that. Done extremely well. I hated it. I hated coming in. I told the founder, Paulina is her name, literally within 3 minutes of her starting our pitch, I don't understand why you'd build a business around buses. Poor people ride buses. How are you going to build a business there? She calmly deflected that, had numbers, kept going, and I kept attacking her all the way for a 45-minute call. I am beating the living hell out of her. At the end of it, what did she say? I just booked you a bus ticket on our system for a bus trip tomorrow. Hope you enjoy it. Is that not gutsy? Yeah. I called Chris afterwards. I said, I hate this thing. We need to bet on it right away.
But that sort of like healthy tension that you can create where there's a little bit of shock value, but not in an insulting way.
Right.
But it kind of creates that healthy tension and spark of interest like, wow, this is different. This is not everything I've seen before.
That's right.
I would say when I've created that environment in a pitch meeting, those people invested.
That's right.
When I didn't,
that's right.
They did not invest.
Yeah, I spend all my time beating it up, not because I'm trying to be a jackass. I mean, that's natural, but I'm really what I'm trying to do is to see, because if I can find cracks in it, and I can tell you about 30% of the time by the end of a 40-minute call, if 30% of the time I have the founders doubting their own pitch. If I have them in 30 minutes that questioning their own thing, why would I possibly give them money? That's really healthy. That's really good. I can tell you as much and as brutal as I am. I am very brutal. I am completely honest, but I am completely brutal. I will tell you most people come back and thank me at the end of it.
I did. No, it's like that's how you learn the fastest, because who else is going to give you that harshest of reality checks other than someone that you're asking to part with their cash in exchange for a portion of your company? Because your friends, your family, even your customers, they're too invested in the relationship with you to
and they're all
disappoint you.
liars. They're all liars. I tell people that all the time. If you see somebody's mouth moving, they're lying to you, so let's keep moving. So that's what people do. Especially, and investors, you would think that they're honest. Startup investors are the worst. They're the biggest liars. They're never going to honestly tell you they don't like what you're doing. They'll never, I don't know any that do that. And why? Because they never want to look like they're wrong. They don't want to miss the next Google. Now, they'll do all kinds of things that you need, that are code for. No way, I'm never betting on this. But they will never say no. They'll say things like, oh, you know, really love the team.
They'll send you on homework assignments.
Right, homework assignments. Really love the team. It's just not a fit for us right now. You got to make sure you come back and tell us in 3 months how it's going and re-engage with us. That's code for, please don't call me. That's what they're actually saying. But they're never, ever going to tell you no. I started my life on that side of the table. I was a founder first. Chris and I both were founders first. And I made the promise as a 25-year-old kid, and the crap that I had to go through trying to raise money, that I would never be that person on the other side of the table. I would never, ever, ever, ever sit there and just blatantly lie and not honestly tell me that I'm on the wrong path. So I took a totally different approach. And I've only had one team ever give me the finger, and I've only had 3 teams I made cry. So I think that's a really good stat. So I've done very well.
I want to talk on like the IP question that you asked, though, originally. The thing that's changed, it used to be that the pace of innovation was every decade, right? And then it became every half decade, and then it became every quarter decade. The biggest risk to a venture used to be protection of the research and development productivity. Right? That was going to be the biggest threat. Someone is going to steal our idea or our secret sauce or our execution, and that is why this venture will fail. If you fast forward to now, the reason your venture is probably going to fail is because someone else is doing it better, faster, and cheaper than you are, and how you're doing it and how you plan on protecting it is totally irrelevant because they're just signing up more customers. And the way you move more quickly now is you don't need $10 million to get a proof of concept together. You can now do it on 10,000. You don't need a team of 100 engineers to build most startup ventures that you see being formed. You could do it with 1. The entire platform that we've built was built by 1 dude working part-time. And that has been the entire foundation of our company. All of our server infrastructure, outsourced. All of our operational infrastructure, outsourced. All of our analytics platforms, our databases, our email systems, everything that we do. We don't run a single server. We don't operate a single piece of technology. We just have laptops and internet connections, and that is everything that we do.
And that's in a startup where most of the team is technical.
Yep.
So it's not like they're not technical. Most of the team are technical.
Yep. And it's what it takes to move that quickly now is not a ton of capital. It's just knowing the right pieces to pull together, and it's not being able to execute fast enough and deliver enough value to customers and command time and attention in the market. That's why you're going to fail.
And just even to broaden it, because Cory's his reference point is mostly software, because that's what he is. I have 2 hardware companies that also move extremely fast. And why? 3D printing, an innovation we didn't have before. They can come up with a new prototype and print a new prototype really quickly when before it had to go to injection molding or ship it to somewhere in China so that they could get a handful of prototypes made cheaply. Now they just print it. They literally just go print it.
And I don't want to say it's not important. It is important, but it's not why you're going to fail.
That's right.
It used to be why you were going to fail. It is not why you're going to fail now. But after you've de-risked those other pieces that will be the reasons you're going to fail, now the property protection becomes extremely important. But then is the right time to address it.
Mark?
So if that's the case, why is the second question an investor will ask you, after how committed is the team to this idea, what is your intellectual property protection?
I have never been asked that for any venture that I've done.
Software.
Yep, for software.
And
the second, even if that was my instant clue, okay, then this is not the right fit of an investor because that's not what we're going to fail. Like everything we've even Dyn, even though that was software, that was a hardware footprint of where we had data centers in the world, how we connected them up to the internet, and then our competency in being able to operate and evolve those connections as the internet evolved. Like our core competency and our advantage was people. The people that understood that, the people that could evolve it and could maintain it, we had the best and brightest people in the world that could do that. Twitter didn't have them. Amazon didn't have them. Netflix didn't have them. We had them. Right? And we were the ones that were able to provide those services to those companies to help make them successful. Right? And so it was those pieces that gave us our competitive advantage. So even though that, I wouldn't call that a software company. Like that was a network company that just happened to use software to get its job done. Those are the trends that we're seeing more and more and more, where those are the reasons why you're going to fail.
Yeah. I think, Mark, in your for your frame of reference there, I think definitely not in the software world. I would agree with Cory. I almost never hear that question, and I would never posed it myself. And even in most of what is hardware, I don't hear it very much. I definitely hear it in places like embedded systems. Biomed is another place. And things where the sales cycle is insanely long. Think you're selling to government agencies with 3 letters.
Material science.
Yeah, material science is another example.
It goes back to, do you need millions of dollars to
right.
do research and development before you can generate $1 of revenue?
That's
If
right.
so, intellectual property protection is going to be very important.
That's right.
But now there is an entire category of investment and a majority of investment dollars where that's just not the case.
Are there other questions? One that I'd like to ask. Oh, sorry, go ahead.
I just wonder what some of your other no's in the first 30 minutes are.
That's great. The easy no's are the team is dispersed. Here's how a pitch usually goes. So the founder gets on. He or she's doing her thing. They're doing their thing. Can't get that English correct no matter what you do there. So anyway, the pitch is going on. And at some point they'll say, we are doing this. I instantly stop them and say, can you tell me about the we? And they'll usually say, they'll make the fatal mistake of, well, I've got 27 people working on this. They'll start naming them. And I'm like, okay, you're burning no money and you have 27 people working on this. How are you doing that? How are you paying them? Well, yeah, not really. Okay, so let's dig into this, because I bet you 27 people aren't working on this. It's more like you and a cast of characters that you get like 15 minutes from every 6 weeks. So I'm already breaking down the founder to really understand them. When they try to make that opaque, it's almost always a no. If I can't get them to honestly understand that they're not compensating people and therefore they're probably not getting anything done, bad, it's a no. Because I know I'm going to have run into other problems that they can't really get truthful about. It's a big mistake in my thinking at the early stage to make your team sound bigger than it actually is. Another big no that is connected to that same line of questioning is cap table. I always ask, tell me about the cap table on that we. If the founder has no idea or the person pitching has no idea what a cap table is, also a no. If I have to explain what a cap table is, also a no.
Can you explain that?
A capitalization table. Who owns what of the company at this point? If the answer is weird, it's a no. If they have more than 3 people that own the company at that point, it's a no.
If there's anyone who owns the company who is not spending most of their time and energy thinking about how to make that company successful,
it's a no. Unless they put in a ton of money or something. I mean,
Yeah, so that's a question I had. Do people come to you already with any angel investing, or are they always self-funded?
it's all over the place. It's all in our range. It's all over the place. So most of the people we talk to have raised less than a couple $1 million. So if they've raised more than that, they're probably not talking to us anyway. But less than a couple $1 million, they're talking to us. And then that can be all kinds of flavors then, I mean, as far as where that money came from. I had a team that pitched me a couple days ago, a team of 8 people, and they were $3 million in, but it was all their own money. So, and they were still nowhere, which is also bad. That's usually a red flag too. If you're that much of your own money in, then you're way beholden to something that's probably broken, and I can't fix you anyway.
Kickstarter money, which seems like it would be different?
No, yeah, totally different. That's non-dilutable cash. The only thing that comes with Kickstarter money or any of those crowdfunding situations, as long as it's non-dilutable cash. Non-dilutable cash meaning you didn't give up any equity for that. As long as there aren't product promises, that's where people get into Kickstarter trouble. Is that they run these Kickstarter campaigns and they promise that they're going to deliver a product, as part of it, and that product's always later and it's more expensive and they're behind schedule, and now they've got on their books basically a liability to deliver something that they might lose money on. So raising that money actually didn't help them. So you have to be. That's the only caution there.
Well, in Kickstarter, the more you could think about that as a marketing tool as opposed to a fundraising platform, the more you're going to be successful there. Yeah. Because the amount of money you can raise on Kickstarter compared to the ambition that you need to sit out and tell a story to be successful raising money, there's a huge gap there. And that's where you get into the kind of mismatched expectations, over-promising, under-delivering that just pisses everyone off. But if you can build something great and then bring it to people and generate a lot of viral awareness through a platform like Kickstarter, I mean, that is how Pebble took off. They didn't need that money to make it successful.
It's a marketing platform more than it's a dollars platform. I will tell you that of the 20 largest Kickstarter campaigns of all time, 3 are portfolio companies of mine. So it does work. Tracker, I think, raised in their second one like $1.7 million in like 2 weeks. So, but it can work.
Who are the other two?
A company called Monstrous, which you may or may not know, they got acquired very quickly, actually. So to Cory's point, they ran a Kickstarter campaign, got like $1 million in like a couple week type of situation, and got acquired before they even got a product. They got rolled up into another startup. Basically, a private equity firm came in and said, we've got this mess over here, and you can solve it, so we'll just buy you out right now. And then a company that went belly up, just to show you that even if you get a lot of money, TechTrack, in the early days of Kickstarter, may not be in the top 20 anymore, but it definitely was in their top 5 in the early days of Kickstarter. They built something that you'll say, gosh, I have that already. Apple allow you to find your Apple product anywhere, any kind of Apple iPhone. They could find an iPhone anywhere. So it was a plug-in to an iPhone that allowed you to find it. Apple rolled out the product and embedded into the phone itself and pretty much killed the company. But they raised a boatload of money on there as well.
Other questions? I don't know.
You told us what not to do with the first round of funding. Cory, what did you do with yours?
My first investor pitch, I was 19 years old, sitting in Cambridge, trying to convince someone that they should fund a business that I was making hardware to automate data centers, and they rightfully said no, because that was a very bad company to build. I learned a lot building that, but I'm glad in retrospect that I didn't commit a decade to building that. I learned that lesson in only 4 years. But I learned there, okay, it's not about what my idea is or what the business is. It's, do they trust me to actually return them on the capital? And then fast forward to the growth equity round that we did with Dine. That was all, how are we going to take this business to the next level with your capital coming in? Fast forward now back to this early stage round that I put together, which is really, this is how we see the world. This is what we think it's going to look like in 10 years. Here are the fundamental trends that are happening of why that's going to come to fruition. Here are the things that everyone else is getting wrong in how they're trying to tackle this really, really big problem. And here's our data that shows we're on the right track. We don't have the exact right answer yet, but we are committed to building this efficiently, building it with the least amount of capital, and learning mistakes A, B, and C that we saw everyone else make. And that is, you're investing in this team of people that I have helped pull together that is committed to that. What we actually do, what our brand is, what market we play in, is actually all just means to an end for us, because we care about getting this indoor location infrastructure deployed out in the world, and that is what they're fundamentally investing in. But it took us a long time to figure out that pitch and that story. First time I sat down with people, I said, you should invest in automatic loyalty rewards. They all laughed at me.
I did.
Yeah, you did. Because there was just no money to be made, and it was very difficult to go to market. And then we said, no, actually, we want to build the infrastructure, and loyalty rewards are our means to get an app on consumers' phones that are interacting with the infrastructure. Okay, but how do you get the locations? Right? That became kind of the next round of no's, no's, no's. The second it became yes, the story became this. Do we believe that if someone could build Google AdWords for the real world, that will be a $10 billion company? And everyone around the room would go, yes. If you could build Google AdWords for the real world, such that as you walked into places, it could do tailored engagement to you and put the right message in front of you at the right time, that was going to be an extremely valuable opportunity. They said, okay, great. Well, do we believe Apple iBeacon and indoor location technology is what makes that venture possible now, and it wasn't possible before? Potentially. Not a definite yes, but we could see promise there. Okay, do we believe that everything else that people have done to try to build this venture that looked very scalable and extremely fast growth on paper has failed? Absolutely, hands down. Roadkill, 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 roadkill.
Hundreds of millions of dollars, too, on that roadkill, just so we're clear.
And so that became the core of our story, which was the people that will figure this out are the ones that put together the right combination of value to a consumer, value to a location, and then how to find the natural behavior in the world that lets you grow that business very quickly. And what I meant by that was we have an app that consumers put on their phones, but we don't actually go out there and get people to install it. Our locations do that for us. Just like they were using loyalty programs through punch cards or QR code scanning or carrying magnetic stripe cards or any sort of loyalty program, they're now promoting the Adored app instead of those siloed applications or those siloed programs. And that's how we got our 6,200 customers, 200 users to date. Right? So that was natural behavior in the world that we were leveraging to get that done. And the next challenge became, all right, how are you going to get all the locations? Well, similar thing. Find the natural behavior in the world and leverage that. Mount Washington Valley Chamber of Commerce needs to understand what's going on in their region, needs to understand where people are coming from and how they're moving around in the region, how many days they're staying. And the best way they could do that is capturing survey information with people on clipboards, right? All of our data is anonymous. You don't create an account. There's no username. There's no password. You don't give anything about yourself. But we can help them understand how to engage you better. And in return, they've helped with the introductions to great locations. And just last week, 9 locations came on board, facilitated by that Chamber of Commerce. Right? So there was an example of finding the natural behavior in the world that we can leverage to grow this thing very quickly. As soon as we formed that story, yes, 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 on the investor circuit. But until then, it was, we consider investing in you, but we need to see this fleshed out a little bit more, which was true. It was good feedback to get.
Thank you. That was great. So just about time for us to wrap up, and you have a captive audience. Is there some observation, lesson learned, words of wisdom you'd like to impart?
Yeah, the only thing I'll go back to, two things. One, I'll go back to my dreams thing, is that understand very firmly what and it's not the company dreams, remember that. It's your dreams as the founder. Your personal dreams are what matters. And they have to absolutely match the rest of your staff's dreams, and if you take in money, those dreams. And then the other thing that I want you to take away here is that you really shouldn't raise money until you don't need the money. It's like any other banking situation. If you come in desperate for money, I can smell that. And that doesn't really feel good for me either. It's not that I'm going to take advantage of you. I'm probably not going to bet on you. I want you to come in when you don't need the money. It's a much better conversation all the way around if you don't need the money. We're going to do an investment in a company in Phoenix right now, and that investment is going into a company who does not need the money. They literally just want us in the round just to say we're in the round.
For instance, we're doing this $1.5 million round, but we have 6 months of cash in the bank.
Right.
So we don't need the money. This is the perfect time to be raising that round.
Yes. And
we're communicating it's for a very clear milestone. We've proven what we've done to date. Now is time to prove it in the greater Metro Boston area And this capital is intended for us to prove that and prove that we can generate revenue in these kind of proportions. And then we communicate. The milestone after that is we go into the greater New York area, and we rinse and repeat that pattern. But we're communicating those as milestones for the business, and not just growth or number milestones, but why they're strategically impactful. We need a certain critical mass to prove out we can build this revenue model the way we expect to build it out. That's what we're de-risking. When you're coming on board in this funding round, you believe in the people, but you believe there's some risks that need to be mitigated, and you have confidence that they'll be mitigated. But then you have to go back and say, all right, now the milestone is going to be this, and this is what we need to mitigate those risks now and continue to grow it up until you become a growth company. And then it's how do you move faster? How do you move the different levers? How do you acquire more customers? Because you've already figured out what the business is.
Awesome.
Thanks.
Thank you, guys. Can we give them a round of applause, please?